America's national debt has ballooned to an astonishing $37 trillion, and inflation continues to erode the dollar's purchasing power. With these challenges mounting, some experts are asking a bold question. Could the United States leverage its gold reserves to help manage this crisis? This idea has been gaining attention recently, particularly as Treasury Secretary Scott Bessent commented by saying, "We're going to monetize the asset side of the U.S. balance sheet for the American people." And the audit of gold at Fort Knox proposed by President Trump and others may be a sign this is under serious consideration. But is this a realistic solution? The U.S. holds the largest official gold reserves in the world, over 8,100 metric tons. On paper, this sounds impressive, but there's a catch. The Treasury values this gold at just $42.22 per ounce on its books, a figure that hasn't been updated since 1973. Compare that to today's market price of around $2,900 per ounce, and the true value of these reserves is closer to $750 billion. This massive gap between the book value and the market value is where the idea of revaluation comes into play. The reason this could be under consideration is that if the Treasury were to officially raise the book value of gold to match the market price, or even higher as some analysts have suggested, it could create a significant financial windfall for the U.S. government. The difference between the old valuation and the new one would be credited to the Treasury's gold certificate account at the Federal Reserve. And from there, the Federal Reserve could credit the Treasury General account, which is essentially like the government's checking account, with the equivalent number of dollars, monetizing gold into dollars. In theory, this could inject trillions of dollars into the government's coffers, which they could then use to help pay down debt or fund other initiatives like a sovereign wealth fund, without the need to issue new debt. To be clear, if the United States Treasury does revalue gold to a higher price, it doesn't mean the market price of gold would automatically adjust to that new number. It's an accounting metric only, just as currently being valued at $42.22 today certainly hasn't held the market price of gold near that level. In fact, revaluing gold on a government's balance sheet to more accurately reflect market price is common practice among some other governments. While this might sound like a clever fix, the reality is far more complicated. Revaluing gold could have ripple effects across the global economy, and not all of them would be positive. For starters, it could send shockwaves through the financial markets. Gold is a cornerstone of the global monetary system, held on the balance sheets of all major central banks worldwide. A sudden and significant revaluation by the U.S. could destabilize currencies, commodities, and international trade relationships due to the impact of potentially trillions of new dollars being created and entering the economy. A flood of new dollars put into circulation would further inflate the money supply and potentially weaken the dollar. A weaker dollar would make imports more expensive, especially when simultaneously faced with tariffs, driving up costs for everyday Americans. At this point, you may be wondering, could revaluing gold really solve the debt problem? The short answer is no, not entirely. Even at a higher valuation, the U.S. gold reserves are nowhere near enough to cover the entire $37 trillion debt. At best, revaluing gold would provide temporary relief, not a long-term solution. It's a bit like using a bucket to bail out a sinking ship. It might buy you some time, but it won't stop the ship from sinking. To put this into perspective, consider a historical example in the 1930s. During the Great Depression, President Roosevelt famously revalued gold from $20.67 to $35 per ounce as part of his New Deal policies. This move helped stabilize the economy at the time, but it wasn't without consequences. The revaluation effectively devalued the dollar, which hurt savers and those holding cash. While it provided a short-term boost, it didn't solve the underlying economic problems. History shows us that revaluing gold can be a powerful tool, but it's far from a silver bullet. And what about the impact on the gold market itself? If the U.S. were to revalue its gold reserves, it could set a new global benchmark for the value of gold held on central bank balance sheets around the world, allowing more countries to follow a similar path and inflate their own money supplies without as much concern about their currencies losing too much value to the U.S. dollar global reserve currency. This would likely trigger a surge in demand for physical gold and its price, as investors and central banks scramble to acquire more of the metal to deal with rising fiat money supplies around the world. So what does all of this mean for you? The truth is, there's no simple solution for America's debt problem or the global debt problem for that matter. Whether it's revaluing gold, printing more money, or raising taxes, every option comes with significant trade-offs. And as the government grapples with these challenges, the value of the dollar and your savings could be at risk. That's why so many Americans are turning to gold as a personal hedge against uncertainty. Gold isn't just a shiny metal, it's a time-tested store of value that has preserved wealth through wars, economic crises, and currency collapses. While governments debate how to solve their debt and fiscal problems, you can take proactive steps today to protect your financial future by diversifying with physical gold.